depreciation is back. In today's video, we're going to be talking about how to save a massive amount of money on your taxes, how to scale faster, all by using bonus depreciation. Hi, my name is Alvin Taveras. I'm the president and CEO here at Build to Rent, and I use bonus depreciation on all of my properties. My wife and I use it to offset all of her earned income. She's still a W-2, so we get to offset all of her earned income, and we get an actual refund at the end of the year. When I was broke, we would use a standard deduction, and we would get a refund each and every year. We had kids, so the refunds would be there, and you could then plan to then use that money to do other purchases. Now that I'm no longer broke or middle class, I'm kind of having a different bracket right now, and I invest heavily in real estate, I'm back to getting a refund each and every year. So I'm going to explain to you how to maximize the benefits of a bonus depreciation using a cost segregation report. We're going to go into that in detail today. But first, I want to talk about just what is bonus depreciation. So bonus depreciation allows you as an investor, as a business owner, to depreciate the entire value of an asset within just 1 year. Now, if you had a company and you bought a pencil, obviously that pencil cost you $1, and that dollar would go against your earned income to figure out how much you actually made that year. You would then pay taxes based on the amount that you made that year. Now, when it's something a little bit more complicated, like a warehouse, an investment property, or even a truck, usually the government would have to depreciate that over a certain number of years. So here's the key. When we talk about using bonus depreciation, you can't use it on the entire house. So what you do is what's called a cost segregation report. And a cost segregation report, basically you would hire an inspector, or if you're using Build to Rent, we have all the details in the new construction property, so we can actually break it down for you. But essentially, you would use a cost segregation report to break down all of the components that make up the house. The only part you cannot depreciate is the actual land. You would use your purchase price and subtract the land value, and that will give you your improved property value. So once you get your improved property value, you can then break down that house by different components. Some things like landscaping are going to have a lifespan of about 5 years. Maybe your microwave will last 10. Maybe the concrete block construction walls are going to last a full 27 and a half years. And again, these are technical IRS terms, and you're using this to do a paper loss. Obviously, your property is not going down in value, but you're using depreciation to show the wear and tear that it has received. This is worth noting. We're using IRS terms here. We're not using actual terms. So an actual house will last a lot more than 27 and a half years, or at least it's better. But for the IRS terms, you can depreciate the entire structure over 27 and a half years. And that's called your standard depreciation. So if you didn't do a cost seg, if you didn't do bonus depreciation, you can depreciate the improved property value by 27 and a half years. So the way that we do this for real estate is you would figure out how much of the home can be depreciated within 20 years, because that is now eligible for bonus depreciation if it's within 20 years, and how much of it isn't. The rest of that will get depreciated on a straight line depreciation over the course of 27 and a half years. Okay, to illustrate this map, I'm going to go ahead and show you an example property. Let's actually go to the map. We're going to start in one of our favorite areas, which is Central Florida. And so we like this area a little bit north of Orlando, right next to where the Villages areas is. And it's a little bit north of the Villages. So this is within Ocala. And so we like two communities here quite a bit. We like Marion Oaks, which is over here on this part of town. And then we like Silver Springs, which is over here. And so we like Ocala for a number of reasons. One, it's obviously growing. It's in the path of prosperity, has some of the lowest insurance. Well, it has the lowest insurance rate in the state. It also has some of the lowest unemployment rate in the state. And it's wildly affordable. So we're going to dive into Silver Springs, and I'm going to show you an area that we like a lot. We've been doing a lot of business here. We just put another duplex under contract, and Silver Springs has a lot going on. Obviously, it has its Publix, it has its Walmart. We like this area right here, which is right in between the elementary school and the Walmart. And one of the reasons why we like this is because in this market, we are aiming for affordability. Our rents are below $1,400. That is affordable for most people, especially when we have two incomes. But we like being next to the middle school because our perfect demographic would be a family with school-aged children. One of the things that we've learned with that demo is that demo can't move easily because their kids are in school. And so the parents do not want to move their kids out of the school district within the school year. So they end up being a little bit more permanent than most. We have a couple of duplexes in this area too. And here's a video of what that duplex looks like. Again, highly functional, highly affordable. It meets the needs for most people, and it's a phenomenal option. In this market, we're not going super high end. We're going very realistic and very practical. We are offering our tenants very functional housing, which is key, and the numbers work phenomenal. Speaking of numbers, let's go ahead and jump right in. We have a purchase price of $400,000. That's about $200,000 per door, which is a phenomenal deal. And then when we look at the total down payment, here's the key. The down payment is basically $100,000. Most of our investors put 25% down. And so you can buy a little bit more. Some of our investors are getting interest rates as low as 3.75%. We're including 2 years free property management. We're going to get the rents, and the rents come from our property management team. So these are the rents that we're actually getting from the field. The point is when we put in all the numbers, we're now in a position where we are getting cash flow of over $670 per month, which ends up being about $8,000 a year in cash flow, which is about a 6.5% cash on cash. Absolutely phenomenal. And that's including your turnover and repair costs. We are then looking at the principal reduction. And here's the key with the principal reduction. We know what that number is going to be because if the tenants are paying the mortgage, we know how much of the loan is being paid off each and every month. So this is a surefire number that we are getting. So then we get to appreciation. Now we might be flat this year. Maybe we go up towards the back half at 4%. It's possible that if we start seeing rate cuts soon and early next year, we might go up to 8%. Wherever you are, plug that number in. Everyone is correct when you play the future appreciation game. We do know that it will go up over the long run. You can't have all of this robust growth that we're having in the scarcity for land and not have forced appreciation. And then here's where it becomes interesting. When you start adding everything up, you have to include the tax savings. Now here we're using a standard depreciation, which is the purchase price minus the land cost gives you your improved property. That improved property value is being divided up by 27 and a half years as your standard straight line depreciation. And then you end up with a number that you can then use to go against your earned income. On average, an investor would save $4,800 using standard depreciation. So the total GEI with tax savings, this is basically how much wealth was created, was about $50,000 in the very first year of ownership. $50,000 compared to the $100,000 investment you made. Basically, you're getting half your money back in the very first year. So now let's go ahead and dive into the bonus depreciation numbers and how they're created. And if you don't know, I'm a complete nerd. I love Google Sheets. I love playing with numbers. I like telling stories by putting numbers together, right? So this is key. If you go into the description or even the comment section of this video, I'm going to put a link there where you can actually get this report. So I actually created this calculator to be shared by our investors. So you can play around with it. You'll have your own buried copy of it. And so here's the thing. We have the first page gives us the instructions. We also list all the assumptions here. And then you're going to have the availability to put your inputs here. So when we go into the inputs, right, so you can put your property name, you can put the date. This is a residential property, so we're going to be deducting it over 27 and a half years. That's our baseline. And this property that we're purchasing is $400,000. We're then going to subtract the $20,000. That's basically the land cost, how much the land costs. And as a rule of thumb, we're going to say the closing cost is 2.5% of the purchase price, which in this case is about $10,000. It's going to auto-populate some assumptions. You can go in here and change the numbers. Anything that's in yellow, you can go ahead and adjust. And again, this sheet is yours. You can go ahead and use it, playing around with it all you want. But then to spit out some answers from you. And these answers are going to automatically come out to the schedule. And so when we look at the schedule, here's the main thing, is keep in mind, we are front-loading year one. When we look at the input, we have to look at how the calculation is being put together. So we have the $39,000, that's $20,000 taken away for the land and then added back because of the closing cost. That was 10,000. So in total, we have 390 that we can use for depreciation. Again, that's the improved property plus our closing costs. So on average, a property like that, you're going to be able to deduct $70,000 in the first 5 years, around 7 or 8 in the next 7 years. This means they have a 7-year lifespan. You have about 46,000 that you can depreciate over 15 years. And then the remaining of the structure, this is the amount of the property that will be depreciated over 27 and a half years, is about 265,000. So here's the thing. We are forwarding as much as we can to be depreciated on year one. And so we're going to show what that means. So again, this is 100% tax depreciation. You can actually change the amount of percentage wise. We're doing 100% bonus depreciation. So we're going to depreciate over $124,000 and you're going to use this against your earned income. This translates to very close to $48,000 that you're saving in your taxes. When we go back to the pro forma, and we start plugging in, again, all the numbers are the same. Instead of using standard depreciation, we're using bonus depreciation of over $47,000. Now your GEI with tax saving balloons to over $93,000. $93,000 is almost equal to the down payment. Here's the main thing that I want to communicate in today's video. Is that there's a hard route and there's an easy route. So let's say, for example, you're an investor and you don't mind doing some work and your goal is to get $50,000 so you can pull it out of a property and go ahead and buy another property with it. Well, a lot of investors choose to do the BRRRR method, which is trying to buy a property that's way undervalued with a distressed seller and they want to fix it up, rehab it, rent it out, refinance it, and repeat, right? That's the whole goal. They're going to go through a bunch of unknowns, take on so many risks, still be stuck with an old property that probably needs a lot more repairs on coming. And they're going about investing the hard way. To me, that's dumb. To aim for the same result, but quadruple your effort and quadruple your risk factor, to me, that's dumb. A sophisticated, smart investor would analyze all of the options and come to a fair conclusion that obviously going new construction and maximizing the bonus depreciation to go ahead and buy another property makes the most sense. The $47,000 is the amount that you are saving on your taxes. This would either be if you already paid it as a refund, or it would offset the cost that you would have ordinarily have. The key is you are saving $47,000 when it comes to tax season. And you can then use that to buy your next property. So this is scaling quicker. Using bonus depreciation, you're maximizing the benefits and you want to go ahead and redeploy that capital. This is why I have to buy a property each and every year, because I'm looking at every time I buy a property, I get nearly 100% of my money back the very same year. Now, mind you, it's on different sources, but I still get it back. There's still a net wealth creation of everything I put in. I get 100% back the same year. Now let's talk about who should be utilizing bonus depreciation. Well, pretty much anyone who should talk to their CPA and think about these options, right? No matter where you are, this is a tax strategy and you want to talk to a tax professional. Don't just listen to a YouTuber. Go see your CPA, go see your accountant, talk to your tax professional, and talk about whether or not tax depreciation and what the right strategy is for you. High income earners absolutely benefit from bonus depreciation. If you talk to a doctor that has $1 million payroll, they're not going to get too excited about gaining $700 a month. But you talk to them about how they can keep more of their earned income by investing in real estate. Now they get excited, right? You buy 3-4 properties a year and they can offset all of their taxes. They get to keep more of their earned income. That's better. There's so many people who leave the country, Dubai, Puerto Rico, wherever, and try to save money on taxes. They just invested in real estate. You can live virtually anywhere in the country and pay virtually zero in taxes. This is a no-brainer for anyone who's an active real estate investor, real estate agent. If you're in the real estate world, if you're a real estate professional, you automatically qualify as being a real estate professional. You should absolutely be looking to utilize bonus depreciation. Same for any investor who's building and doing rehabs. If you're in the real estate game, you want to look at utilizing these advantages. So you want to have a conversation with your CPA and figure out, hey, how do I maximize the benefits of bonus depreciation And how do I make sure that I'm a good fit for them? So you want to look at if you are spending 750 hours per year, that's about 13 hours a week in real estate. So you want to see how you can qualify for that. And so one of the things that we've seen is if you are an individual and your spouse maybe is a stay-at-home mom, stay-at-home dad, or they have a side business, they may want to get a real estate license or even manage a short-term rental. And that might be enough to get them qualified. Again, talk to your CPA. But if your spouse is a real estate professional, and again, it's a very broad term that's applied to several different engagements with real estate, not just a real estate agent. But if you can get your spouse to qualify as a real estate professional, you can then use their status to maximize your depreciation. So to recap, bonus depreciations are back. They're absolutely massive. It's super easy on a new construction like the ones that we sell to do a cost segregation report because we have all the costs. We know where they land. It's also super easy to go ahead and play around with the calculator. Again, it'll be in the description or it'll be in the comment section where you can open up and look at your own bonus depreciation calculator and figure out the numbers, play around with it. And thirdly is you want to continuously get yourself informed. And that includes talking to your CPA and figuring out how to maximize the benefits. Guys, real estate is a massive wealth builder. And there's so many avenues you can build wealth. I would say that about a quarter of your wealth is creating by how much you keep your taxable income. If you keep more of your money, now you have more money to deploy. Guys, thanks for watching the video all the way through to the end. Now I want to hear from you. Are you currently using bonus depreciation? Is this something you thought about? Have you had any challenges by going down this approach? I'll be responding to each and every one of your comments. And of course, if you have any suggestions for any videos that I should be making, please let me know. Write it in the comment section and I'll see you all next time. Oh, and of course, if you want to schedule an investor consultation with me directly, go to buildtorent.com and I'll look forward to meeting you. Thank you and take care.